In 2008, the global banking system collapsed under the weight of its own toxic debt. For marginalized communities, this was a familiar story. From the ashes of Tulsa to modern redlining, the financial system has always been rigged. Crypto promised an escape. Instead, it became the illusion of decentralization. Welcome back to Insight Engine. We bought into crypto to escape the gatekeepers of traditional finance. We wanted sovereignty. But by flocking to unregulated digital assets, we ended up funding the exact same trap we were trying to flee. If you're ready to look past the hype, hit like, share this video, and subscribe. Let's get into the data. To understand how we got here, we have to go back to the origin. In October 2008, an anonymous programmer named Satoshi Nakamoto published a white paper proposing a peer-to-peer electronic cash system. Nakamoto designed a network that didn't rely on central banks, deliberately bypassing the very institutions receiving massive government bailouts. Look at the Bitcoin Genesis block. Buried inside the code of the very first block mined on January 3, 2009, is a specific hex string. When decrypted, it translates to a headline from that day's London Times: Chancellor on brink of second bailout for banks. The entire architecture of Bitcoin was built as a protest against state-sponsored financial monopolies. This origin story struck a nerve. For Black Americans and other marginalized communities with deep historical grievances against state-sanctioned financial exclusion, a decentralized, permissionless ledger sounded exactly like the tool required for independence. This stark reality drives adoption. The 2019 wealth gap was $188,000 for white households versus $24,100 for Black households, while 10.6% remain unbanked. Consequently, 25% of Black Americans earning over $50K own crypto, compared to 15% of white peers, hitting 38% for under 40s. The Buy Black movement evolved directly into Buy Black to Bitcoin. The blockchain relies on immutable code, not loan officers. It offered a seemingly colorblind network where human bias couldn't dictate interest rates or deny mortgages. It was adopted as a technological bypass to systemic racism. There is a fatal flaw in this logic. A permissionless digital network doesn't automatically yield structural financial liberation. Code might not see color, but markets still run on capital. To see where crypto failed us, we need to look at how capital has historically functioned for Black Americans. The pattern is cyclical. Wealth and infrastructure are painstakingly built, deliberately dissolved by outside forces, and the community is forced to start over from zero. This photograph shows the Greenwood district of Tulsa, Oklahoma in 1921. Black Wall Street was a thriving, self-sustaining economic ecosystem. In a matter of days, it was burned to the ground. The physical destruction of businesses and homes eradicated millions in generational wealth. Decades later, nonprofit community support faced a similar teardown. The Black Panther Party organized survival programs, free breakfast for children, medical clinics, and community schools. These were grassroots mutual aid networks, filling a critical void, and they were systematically dismantled. FBI Director J. Edgar Hoover utilized the COINTELPRO initiative to aggressively target these specific survival programs. The federal government labeled free community breakfast and localized health clinics as top national security threats, utilizing state power to suffocate them. Today, the tactics are less visible but equally effective. Through initiatives like Operation Choke Point and routine institutional debanking, financial regulators quietly cut off businesses and organizations from processing payments or holding accounts, starving them of capital without a single match being struck. Web3 and decentralized finance were designed to break this historical cycle. The blockchain couldn't be burned down or debanked. But rather than offering true sanctuary, this digital frontier became the newest venue for wealth extraction. Consider GUAP coin. Launched by technologists within the community, it had a noble foundational vision. It was engineered as a decentralized cryptocurrency, specifically to address the economic concerns of the global African diaspora, intending to keep capital circulating within a Black-owned ecosystem. The use case was very real. Traditional financial networks charge exorbitant remittance fees, often between 7 and 10%, just to send money to family in Africa and the Caribbean. A frictionless digital token offered a mathematically elegant solution to bypass those fees entirely. GUAP coin plummeted from $5 to fractions of a penny. Without initial capital, merchant adoption failed, blocking fiat conversion. Zooming out, this volatility echoes Terra's $40 billion collapse. GUAP coin joins a token graveyard where community hope and institutional speculation both hit the floor. Furthermore, the very remittance corridors diaspora populations relied on were choked by U.S. sanctions compliance. Even decentralized networks eventually interact with centralized exchanges, and those exchanges strictly enforce federal block lists, cutting off international transfers. Community projects fail when they lack the durable legal and physical infrastructure required to sustain value over time. An elegant algorithm is insufficient to solve the structural problem of financial sovereignty. In July 2025, President Donald Trump signed the Genius Act into law. Billed as consumer protection, a Guiding and Establishing National Innovation for U.S. Stablecoins Act created the definitive federal framework for payment stablecoins. It structurally reorganized the digital asset market to heavily favor incumbents. The act demands a strict one-to-one reserve of highly liquid assets, audited monthly. It creates 3 exclusive issuer tiers: insured banks, federal non-banks, or state-qualified entities, leaving no exceptions for community startups. Permitted stablecoins are exempted as securities or commodities, removing SEC oversight. The Genius Act operates as an impenetrable wall. The capital required to maintain one-to-one treasury reserves and secure federal banking charters ensures that only massive, well-capitalized institutions can scale it. The Genius Act is only the top layer. To launch a legal community coin, developers face a crushing weight of overlapping federal and state regulations that make grassroots innovation financially impossible. Unlicensed money transmission is a federal felony under Title 18. Securing proper licenses requires clearing 49 state hurdles, including New York's expensive BIT license. On top sits federal surveillance, complying with the Bank Secrecy Act and OFAC to cross-reference transactions against global sanctions. The Equal Credit Opportunity Act creates a specific legal paradox for diaspora coins. While these tokens aim to solve exclusion, regulators can interpret race-specific financial vehicles as a form of discrimination against other groups. This exposes community developers to predatory lawsuits or federal investigations for simply trying to target their own community, a liability that neutral corporate coins never face. Regulation acts as a competitive moat. The legal and compliance fees alone require millions of dollars upfront. This inherently rewards proximity to existing capital, cementing the dominance of corporate coins like USDC, while pricing out Black grassroots innovation entirely. It is true that early individual adopters built real wealth during the crypto bull runs. A handful of savvy traders turned modest investments into millions. But individual windfalls do not translate to systemic community power. The collective financial infrastructure remains weak. The decentralized Web3 market replicated the exclusionary practices of traditional finance. Power simply shifted from Wall Street executives to anonymous venture capitalists and crypto whales, leaving the underlying disparities exactly where they were. We have to stop looking for technological loopholes. The objective must shift toward leveraging legally protected, durable financial frameworks that are actually designed to hold and grow capital in the real economy. The first tier of this viable infrastructure already exists. Black-owned banks and credit unions are fully chartered institutions. By utilizing the Community Reinvestment Act, we can force regulated local lending, ensuring that deposits actually fund local housing and small businesses. As we have seen with the Genius Act, a theoretically race-neutral regulatory framework remains structurally hostile to undercapitalized communities. The rules are written for those who already have the money. This matrix shows resilient group economic models. We need to fund community development financial institutions, scale worker-owned cooperatives, and employee stock ownership plans, and formalize analog pooling structures like SUSUs. These are the engines of collective wealth. True financial sovereignty is a problem of intergenerational time. It is not caused by a lack of innovative technology, and it cannot be solved by a fast-moving software update. Hype-driven digital tokens are fragile. They evaporate when the market turns or regulations tighten. In contrast, established analog cooperative economic models have deep roots. They are legally recognized, legally protected, and possess proven intergenerational resilience. The imperative is clear. We have to stop trying to invent the next big thing and commit to building the next durable thing, infrastructure capable of surviving the Genius Act and whatever legislation comes after it. Financial liberation doesn't come from escaping the system. It comes from owning the infrastructure. That's what we do here at A Black Girl's Guide, bringing awareness and leadership to emerging tech, so we stop getting played and start building power. Thanks for watching. I'll see you next time.